Alrighty, so this is going to be part 2 of the ICT Masterclass, and we're going to use yesterday's trading session as a great example to illustrate a few concepts, right? So in terms of today, we're going to be talking about the New York AM session, right? So that's the session that we're focused on. In part 1, we talk about the London session. So if you trade London session, check that out. But these concepts are still important, right? Regardless of what session you trade. First thing I want to talk about is the market maker buy model. I want to extend a little bit more on that and talk through that. The second thing I want to talk about is accumulation pockets. Extend on what we talked about from the last lesson. I also want to talk about the 9:30 to 10 o'clock opening range liquidity. And I want to talk about the Judas swing, right, around this time frame. And generally speaking, I want to talk about equal highs and equal lows and how I can actually mitigate that. So if anything else pops up, I will note this there, but these are generally like the talking points for today's session, right? So no real plan apart from this for this stage. So firstly, I just want you to look at these two relative equal highs, right? We talked about equal highs, equal lows in previous videos, but also in the last one. And notice how the price is like accumulating here. Whenever I see accumulation, whenever I see price doing that, my eyes always go towards the highs. Are they relatively equal? And they should be if it's an accumulation pocket. So for me, that is always something that I use as buy side liquidity. So if I was trading the AM session yesterday and the price was, roughly down here somewhere, I'll be aiming for that buy side liquidity because we know equal highs, equal lows. It's like a magnet for price. That's the first thing, right? Secondly, in the 5-minute time frame, it's quite interesting because what you see is you actually see the power of 3. You see that happen, right? You've got all this accumulation, right? Even though we're moving down here, you've got this little accumulation period, like right here. You've got the manipulation period right here. And then you've got your distribution period to the upside. So accumulation, manipulation, and distribution to the upside here, right? Along all of this, you've also got the market maker buy model, right? So I've made another video on the market maker buy model. You might not have seen it, but essentially there's two sides of the curve, right? So in terms of the buy model, you've got a sell side of the curve and you've got a buy side of the curve. So I'm going to label these two curves. So this one here is the sell side of the curve. And this side is the buy side of the curve. Now, what will make you think that there's a market maker buy model or a market maker sell model in play? For me, it's the accumulation pockets. If I see price accumulate, step down, accumulate, step down, accumulate, step down abruptly, then I mix both the market maker buy model concept and the power of 3 and anticipate higher prices, right? So often, not always, but often, the power of 3 will be the last kind of down movement before that buy model plays out. So power of 3, we take out buy side liquidity. That is when the buy model is complete, right? So we're going to leave that there and we'll talk through it a bit more as we kind of go along. But essentially, in terms of the power of 3, we talked about that in the last masterclass, accumulation, manipulation, and then distribution. This manipulation, right, it actually happened roughly about 3 o'clock, right? We manipulated in price, and you can see once we manipulated in price and took out sell side liquidity from here and tapped into this imbalance, we didn't go any lower. So London session yesterday formed the low of the day, So this is a perfect example of the power of 3, right? So in terms of the market maker buy model, that's what you're looking for. You're looking for accumulation pockets. Treat those as buy side liquidity points because the market should be able to take out at minimum this high and these highs if you've got the analysis right. Accumulation pockets again hold a lot of liquidity because imagine how many people are getting chopped in and out of the market there. Plus there's also a lot of stop losses above these swing highs. People see that as resistance, they're going to place their stop loss there, which equals money, right? So we're going through the markets and now I want to kind of discuss the 9:30 to 10 o'clock opening range liquidity and the Judas swing, right? That can often happen. So if you want to take a screenshot, take a screenshot. But the market maker buy model, great example yesterday, right? sell side of the curve, buy side of the curve, power of 3, beautiful example yesterday. And you might be like, okay, well, where's midnight open price? Let me get that up for you. So midnight open, if I go to the exact candle, let's go to it. Midnight candle is probably about here. So if I draw this line below that, we're going to come back to that in just a second. I'm going to come back to that in just a sec, right? We accumulate at midnight open, we manipulate past midnight open, we distribute to the upside, and look what price does here. Look at this. And we're going to talk about this in a bit more depth, right? We're going to expand on this and talk about this in a bit more depth. So on the 5-minute chart, quite obvious, and I think we're going to stay here for now, and then we'll touch base on smaller time frames. But what I want you to look at is the fact that we come above midnight open, and then we sell past midnight open. And I want you to kind of think about what are we doing by coming below midnight open. See these two lows? They're relative equal lows. So what the price is doing, we've pushed up, right? The market opens at 9:30, and then from 9:30, right, the next 10 minutes or so, look at this fake move to the downside. Quite an aggressive move to the downside. All that's doing is taking out this sell side liquidity. So we're taking out sell side liquidity. Now, we know the market, again, targets two things. Liquidity, highs and lows, and imbalances. So when you've got liquidity that rests, for example, in this case, just above an imbalance, it's great. Or if it was buy side liquidity, just below an imbalance, it's great, because then the market can fill the two roles that it needs to do, right? So essentially what happens here, the market comes down, we take out sell side liquidity. The wicks do the damage, the bodies tell the story, right? So the wicks take out the stop losses below these relative equal lows, and we immediately displace back to the upside, right? The fact that we're below midnight open is even better. So for those that like to buy stop losses, that there would be opportunity as soon as this candle closes, right? We're below midnight open, we've just taken that sell side, and we've respected a 5-minute busy or bullish fair value gap. For those that don't like to buy the stop losses and want to see some kind of other reaction, here's what you can see on the 5-minute. So notice this candle's low and this candle's high. There's a bearish fair value gap, but we disrespect it to the upside, right? This bearish gap, we disrespect it. That now becomes an inversion fair value gap. So I'm going to mark that out. That there should be the next signature in price that maybe we want to head a little bit higher, right? So an inversion fair value gap is created. We come back down and we trade into that inversion fair value gap and also into this busy, right? So technically there's like two PD arrays or two things that you could enter from here. And this is on like the 5-minute chart. So what I like to do if I was in the AM session is, if you notice things on the 5-minute time frame, for example, or the 3-minute or 2-minute, anything higher than the 1 minute, which usually I execute on, I'd mark those out in the 5-minute and then come back to the 1-minute time frame and see what it looks like. See how kind of price trades in those zones. So notice that's the 5-minute inverse, that's the 5-minute busy, and look how price reacts there. Look how it respects that, right? That there could be your entry point. If you weren't happy with that and you wanted a bit more confirmation, then you could wait until you get a break of structure, some people call it, or a shift in structure again above this swing high. So there now is a market structure shift. That there's signifying that price wants to go higher. And then again, where could you enter from? You could enter from this bullish fair value gap. Where would your stop loss go? So say you entered from this bottom one. If you entered from the inversion fair value gap, you could put it below this 5-minute busy or this candle. That's completely fine, because technically that should hold. It should hold. If you entered from here, you could place it below this swing low, or you could place it below this candle. Depends how like you want to manage your risk, but this swing low would be completely permissible. And then where would you target? This high, whatever this was. This was like an accumulation pocket, I believe. Yeah. There you go. So that would yield you a 1 to 2 risk to reward. And if you wanted to go 1 to 3, you could do that too, right? So you can see that there's always opportunities to enter the market. And I think here it's a bit more clear in terms of having a fake move just after 9:30, between 9:30 and 10, right? So 9:30, I'm just going to mark out that price. And a lot of the time, ICT, like he traded this move down here. So he traded that manipulation leg. But a lot of the time ICT watches price from 9:30 to 10 because it's like the opening range, right? Sometimes the opening range has the fake move or it has the Judas swing. Now in this case, compare this move down, right, from this swing high to this swing low, to the move up from this swing low to this swing high. The move up is much larger, so that there's your manipulation move. So all price is doing, it's creating this false kind of sense, manipulates the downside to take out liquidity, and then immediately rejects the upside to then use these PD rays to project further high. And again, this is the accumulation high that we talked about before, right? Now, with all this being said, there's other factors that also come into yesterday's session too, which I think are important to discuss. So firstly, let's talk about the change in the state of delivery, right? These are the last two down close candles before a shift in structure. So technically, here is a market structure shift also. That there is a shift in structure. So these last two down close candles, right, they're quite prominent. There's also a rate of liquidity right here internally. When we break above the opening price of this candle, and I'll mark it out, and I'll extend it across in time, that indicates a change in the state of delivery. And all that means is it's changing potentially from bearish to bullish, right? So change in the state of delivery. After the change in the state of delivery often is a market structure shift, as you can see, right? And then price returns back again. So you can see, and you can use these confluences to kind of aid you and help you out in terms of what you'd like to do. Technically, this candle here would be a breaker block. It's the up close candle in between two lows, one of which raises the other, so that there is also a breaker block. Right? So you could use that as soon as price trades through it. You could use that as a breaker block. But let's talk about a few other things and then we'll tidy up this video. So we've talked about macros before, but let's kind of touch base on them again, because here or yesterday it was like a perfect example. If you were trading the AIM session, the macros were like beautiful. Looking back at this morning, like it was perfect. So 950 to 1010 is one macro, and I guess the question for you is, what important pieces of information does this macro give us? Does it give us an opportunity to enter? And then how would you use it? So it's kind of yes to all those questions. So this macro, if I have a look, it shows us a change in the state of delivery, right? It shows us a market structure shift. It shows us the fact that we disrespected the 5-minute bearish gap and we created an inversion fair value gap on the 5-minute and then a fair value gap here in the busy on the 5-minute. So it gave us opportunities to see things, opportunities to have a market structure shift, change in delivery, but also opportunities to enter, right? So technically, all three things or multiple things that macro kind of gives us, and again, that's from 950 to 1010. So that macro is really important. If you're trading the AM session, especially the AM session, it's only a 20-minute period. Look to see what happens in that macro. So even if you missed all these other things, right, you didn't mark this all on your chart, maybe you're a bit concerned here, see what the macro does. If the macro gives you a market structure shift and potentially a return, go for it. As long as there's other analysis supporting it, right, the macro often will deliver price, right? And you can see what happens, right? We deliver price higher. The next macro I want to talk about is from 1050 to 1110, right? So I've done a video on this as well. But again, this is just perfect. Now, during this macro, what do we see? Look at this. Look at this. Massive, massive move to the downside. So we've got a market structure shift right here. So there is your market structure shift. Now, with that market structure shift, there's also other things you can use as confluences, right? So again, I told you that sometimes I go to like a higher time frame and I mark certain things out. This here, right, this 2-minute gap, once we disrespect that and close below it, it now becomes an inversion fair value gap. So if I extend that across in time, that now is a 2-minute IFEG or inversion fair value gap, right? You've also got a 2-minute fair value gap here. So what you can do, if you don't see something on the 1-minute, you can go to the 2-minute and then just impose that on the 1-minute chart. So again, that there is now a 2-minute CB. And if I go back to the 1-minute chart, have a look at how that looks, right? And let's just play price a little bit. What happens from this zone? Look at how we deliver from that zone, and we'll talk about that in a second. But thirdly, right, there's also a breaker block. Right, there's also a breaker block. Now, these three candles technically are a breaker block, and we return to that here. These two candles are also a breaker block. So we've got a high, a low, a higher high that raids liquidity, and a lower low formed here that creates a market structure shift. These two candles are a breaker block in total, right? So what you can do as well is you can mark out that breaker block, and notice here, right? Notice here that there's a point in time, right? I'm going to mark this out in blue. There's a point right here in blue where all three PD arrays line up. All three PD arrays line up. So the breaker block again is this whole thing, right? But in blue, this is where all three line up. So now you've got three confluences to actually enter the trade. You've got the fact that the macro, right, is in play. You've got the fact that we've had a massive market structure shift. We've got a 2-minute inversion fair value gap, a 2-minute SIBI or bearish fair value gap, and here you've got a bearish breaker. So 3 PD arrays, and how would that look for you, right? If you go where all three overlap, let's say take a short, maybe you go right as soon as price touches that breaker. Your stop loss goes above that swing high. You'll take profit. I mean, you could take some off at this swing low. You could just hold it to this swing low. You could hold it for a 1 to 2, but you can see how price delivers there and use those 3 PD arrays to actually head lower. And this is something I want to talk about and kind of emphasize. If you've got 3 stacked PD arrays and you're in a macro and the macro is doing something important, the probability is crazy high. It's crazy high, right? The more confluences and the more, I guess, things you have behind you, the better, right? Same with this one. We've got a macro, we've got an inversion fair value gap, we've got a busy, we've got a market structure shift, and a change in the state of delivery. Think of all these things, right? All these PD arrays, all these confluences. Think of those as like a barrier. It's like a wall, right? It's like if the market was going to disrespect your idea, it would have to trade through all these things. And if it does, it does. You're wrong, right? But if your analysis is right, it should act as a barrier, and price should respect those zones. Like, yes, price returns to this breaker, but look where the bodies close. Yes, price trades outside of this 2-minute inversion, but look at how there's accumulation here. We're accumulating positions here, accumulating to go shorter. Yes, price trades just outside of this SIBI, but what's it doing? It's reaching for this breaker. That's all it's doing, right? So even though we closed above the 0.5 level here, you've got to keep in mind that when you've got other PD arrays, for example, a breaker just above it, and price kind of lines up, it's completely permissible for price to do something like this. Right? Obviously, I wouldn't want price to close like that with a body above the breaker, but wicks like this and then struggling to go outside, that's completely fine and completely permissible. And then again, right, you could see this as another market structure shift. Like if you wanted to wait for those PD arrays to hold, you could actually enter again here. So you could see this as a market structure shift, and then you could enter from this fair value gap on the 1-minute time frame. I'm going to mark that out in purple. So it just goes to show that entry models, there's vast entry models, right? One here, one from the SIBI, one from the inversion, one from the breaker, one where they overlap, right? There's all these places that you could execute a trade on. You could even execute a trade off this order block here. So these last 2 up close candles before a move down, you extend the opening price of this candle out in time. When price trades back into that, you're short. These 2 up close candles, same thing. Bottom of this candle, opening price. When price trades back up, you go short, right? So in terms of like pyramid positions or, you know, executing trades, there's always many opportunities. It just depends on what your entry model is and what you trust the most, right? If you don't feel comfortable entering off order blocks, don't do it. If you feel more comfortable entering off fair value gaps, do it. If you feel more comfortable off entering after you've seen a reaction and getting like a close proximity entry, then do it, right? It's up to you kind of what you want to do. But again, my advice in terms of trading for myself is always use macros. Always use macros. And I encourage you to, you know, back test that and forward test that. So hope you guys got something out of this video. A bit of a masterclass and also a review of yesterday's session. If you've got any questions, feel free to leave them in the comments below. And I'll talk to you guys next time.